I want you to think about the last 5 years before you retire as the most financially powerful window of your entire life. Not the years when you were young and had decades of compounding ahead of you. Not the years when your salary was at its peak and you were maxing out the 401k automatically. The 5 years immediately before retirement. Those 5 years. Because what you do in that specific window, the moves you make, the structures you put in place, the accounts you reposition, the income sources you activate, determines not just how much money you have on the day you stop working, but how much of that money you actually keep after taxes for the next 25 to 30 years of your retirement. Most people treat the 5 years before retirement as a countdown. They are watching the calendar. They are thinking about what they will do with their time. They are imagining the freedom. And while they are doing all of that, they are missing the single most concentrated opportunity in their entire financial lives to restructure their income, reduce their lifetime tax burden, and walk into retirement with a financial architecture that produces dramatically more spendable after-tax income than the default structure they would have if they simply crossed the finish line without making these 5 specific moves. The families who make these moves before retirement routinely end up with 30, 40, sometimes 50% more spendable after-tax income than families with nearly identical account balances who did not make them. Not because they earned more, not because they got lucky, because they understood what the 5 years before retirement actually are, which is not a countdown to freedom, but a tax planning window that closes the moment the last paycheck clears. This is Retire Right America. And today I'm going to walk you through 5 specific moves that every American within 5 years of retirement needs to execute before they hand in their badge. Because after retirement, several of these moves become significantly less effective or disappear entirely. Let me give you 2 couples. Both are 62 years old. Both plan to retire at 67. Both have $450,000 in a traditional 401k. Both own their homes. Both expect Social Security of about $26,000 per year each at full retirement age. By every conventional measure, these 2 couples are identical. Call them the Hendersons and the Garcias. The Hendersons do what most Americans do. They keep contributing to their traditional 401k through age 67. They take Social Security at 67 when they retire. They begin taking required minimum distributions at 73, and they manage their money the way their bank and their 401k provider set it up by default. The Garcias make 5 specific moves in the 5 years before retirement that I am about to walk you through. By age 75, the Garcias have approximately $40,000 more in spendable after-tax annual income than the Hendersons, despite starting from an identical financial position. By age 85, the gap has grown to nearly $600,000 in cumulative lifetime after-tax wealth. Same starting point, completely different financial outcome. The difference is not luck. The difference is not market performance. The difference is 5 moves made in a 5-year window that most Americans let pass without ever understanding what they were walking away from. Let me show you exactly what the Garcias did. The first move is the Roth conversion sprint. Between age 62 and age 67, the Garcias are in a unique tax position that will never exist again in their financial lives. Their employment income is still coming in, but it may be lower than their peak earning years if they have shifted to part-time or reduced their hours in preparation for retirement. Their Social Security has not started yet, their required minimum distributions have not started yet, and they are still filing jointly with the widest possible tax brackets. This is the Roth conversion window. Every dollar they convert from their traditional 401k or IRA to a Roth IRA during this window gets taxed once, at the current marginal rate, and then grows permanently tax-free with no required minimum distributions ever. The Garcias work with their tax advisor to identify exactly how much they can convert each year while staying within a specific bracket. In 2026, the 12% bracket for a married couple extends to approximately $97,000 of taxable income. The 22% bracket extends to approximately $206,000. The Garcias convert enough each year to fill the 22% bracket without crossing into 24%. They do this for 5 consecutive years. They pay the conversion tax from their taxable savings account, not from the IRA itself, so the full converted amount moves to Roth without shrinkage. After 5 years of disciplined conversion, a significant portion of their traditional account has moved to Roth. The money that remains in the traditional account is substantially smaller, meaning the RMDs that begin at age 73 are dramatically lower. meaning less forced taxable income every year for the rest of their lives, meaning less Social Security taxation, meaning lower IRMAA Medicare premiums, meaning a lower overall tax burden that compounds in their favor for the next 20 to 25 years. The Hendersons kept contributing to the traditional 401k through 67 and did nothing to address the tax bomb they were building inside the account. By age 73, the Hendersons are dealing with RMDs on a $600,000 traditional account. The Garcias are dealing with RMDs on a significantly smaller traditional balance because a substantial portion has already been converted to Roth. The difference in annual tax burden between the two couples at age 75 is real, measurable, and permanent. The second move is a Social Security delay paired with the IRA bridge strategy. This is the move that creates what I call the income doubling effect, and it is the one that surprises people most when they see the math. Most Americans claim Social Security the moment they retire, or as soon as they turn 62, because the check feels like free money, and waiting feels like gambling. Let me show you why that instinct is financially catastrophic for the majority of retirees who live into their late 70s and beyond. Your Social Security benefit grows by approximately 8% for every year you delay claiming past your full retirement age, up to age 70. 8%. Guaranteed. Backed by the federal government. There is no investment in the world that offers a guaranteed 8% annual return with zero downside risk. If your full retirement age benefit is $2,000 per month at 67 and you wait until 70, your monthly benefit becomes approximately $2,480 per month. That is an additional $5,760 per year, every year, for the rest of your life, inflation adjusted. For a couple where both spouses delay to 70, the cumulative lifetime income difference compared to both claiming at 67 can exceed $300,000 over a normal retirement lifespan. But here's the challenge. If you delay Social Security to 70, you need income to live on between 67 and 70. This is where the IRA bridge strategy comes in, and why the Roth conversion sprint in Move 1 sets it up perfectly. The Garcias retire at 67. They do not claim Social Security. Instead, they draw income from their traditional IRA during the 3-year bridge period between 67 and 70. These IRA withdrawals serve two purposes simultaneously. They provide the income needed to cover living expenses while Social Security is delayed, and they reduce the traditional IRA balance further, shrinking the eventual RMD that will begin at 73. The Garcias are essentially using the 3-year bridge period to continue the Roth conversion and traditional balance reduction work they started during the pre-retirement sprint, while simultaneously setting up a permanently higher Social Security benefit that will pay them more every month for the rest of their lives. The Hendersons claimed Social Security at 67, kept the full traditional IRA balance intact, and walked into age 73 with a larger RMD problem and a lower lifetime Social Security income than they would have had with a 3-year delay. The third move is the Medicare income planning strategy, and this is the one where the 5-year pre-retirement window matters most because of the 2-year look-back that determines Medicare IRMAA surcharges. As we have covered extensively here on Retire Right America, your Medicare Part B premium in any given year is determined by your modified adjusted gross income from 2 years prior. Your 2026 Medicare costs are based on your 2024 tax return. This means that the income decisions you make in the 5 years before retirement, specifically in the 2 years immediately before you enroll in Medicare at 65, determine whether you pay the standard Medicare premium or whether you pay the IRMAA surcharge that can add hundreds of dollars per month per person to your healthcare costs for years. The Garcias mapped out their income carefully in the 2 years before their Medicare enrollment. They managed their Roth conversion amounts to avoid spiking their modified adjusted gross income above the IRMAA threshold. They timed certain asset sales and income recognition events to fall outside the 2-year look-back window for Medicare enrollment. They made sure that the year they turned 63 and 64, the 2 years that would determine their initial Medicare premiums at 65, their income was structured to stay below the first IRMAA tier. The Hendersons did none of this planning. They had a large income year at 64 when they sold some appreciated stock to pay off the mortgage before retirement. That income spike, which felt like a smart debt elimination move, triggered an IRMAA surcharge that added over $2,000 per year per person to their Medicare premiums for 2 full years after enrollment. The Hendersons paid that IRMAA surcharge because they did not understand the 2-year look-back. The Garcias avoided it because they did. The difference in Medicare premium costs over retirement is not trivial. A couple paying IRMAA surcharges for 10 to 15 years of retirement pays tens of thousands of dollars more in Medicare premiums than a couple who manage their income to stay below the thresholds. That money comes directly out of the retirement income that was supposed to cover living expenses. The fourth move is the pension election and survivor benefit decision. This move only applies to people who have a defined benefit pension, but for those who do, it is one of the most consequential financial decisions of their lives, and it is a decision that must be made correctly before retirement because it cannot be reversed after. When you retire with a pension, you will generally be offered a choice between a single life annuity, which pays the highest monthly amount but stops when you die, and a joint and survivor annuity, which pays a lower monthly amount but continues paying a percentage, typically 50, 75, or 100%, to your surviving spouse after you die. Most people choose the single life option because the monthly check is higher and they want to maximize their current income. This is often a catastrophic decision for the surviving spouse. Here is the financial reality. If you and your spouse are both 67 and you elect single life on your pension, you might receive $2,300 per month instead of the joint and survivor amount of $1,800. You take the extra $500 per month because it feels like more money. But when you die at 78, your spouse loses the entire pension income. $1,800 per month for the rest of their life simply disappears. The surviving spouse is now living on their Social Security alone, potentially a reduced IRA, and zero pension income for what could be 15 to 20 years of widowhood. The better move in most cases, and this is something you must model specifically with your own numbers and your own life expectancy assumptions, is to elect the joint and survivor option and use the income differential, the $500 per month you gave up compared to the single life amount, to fund a permanent life insurance policy on the pensioner's life. This is the pension maximization strategy. If the pensioner dies first, the life insurance death benefit, which is income tax-free under Internal Revenue Code Section 101A, provides the surviving spouse with a lump sum that can be invested or annuitized to replace or exceed the pension income that was lost. The survivor gets tax-free death benefit proceeds instead of taxable pension income, which is better from an income tax and IRMAA standpoint. If the pensioner lives a long life, the pension keeps paying, and the insurance policy builds cash value that can be accessed if needed. The pension maximization strategy is not right for every couple. It requires the pensioner to be insurable at a reasonable cost, and the numbers must be modeled carefully. But for couples where one spouse has a significant pension and the other spouse has limited independent income, electing single life without considering pension max is leaving the surviving spouse financially exposed in a way that a 30-minute conversation with a fee-only financial planner could have prevented. The fifth move is the asset location optimization, and this is the move that works silently in the background for the entire length of your retirement, generating better after-tax returns on the same investment portfolio without requiring you to take any additional market risk. Asset location is the strategy of intentionally placing different types of investments in different types of accounts based on their tax characteristics to minimize the total lifetime tax cost of the portfolio. The basic principle is straightforward. Tax-inefficient investments, meaning investments that generate significant ordinary income every year, such as bonds, bond funds, REITs, dividend-paying stocks, and actively managed funds with high turnover, belong inside tax-advantaged accounts, where their income does not create an annual taxable event. Tax-efficient investments, meaning investments that generate primarily long-term capital gains and qualified dividends at preferential tax rates, such as broad market index funds with low turnover, belong in taxable brokerage accounts where their favorable tax treatment can be fully utilized. And investments with the highest expected long-term growth rates belong in the Roth IRA, where all future growth is permanently tax-free and no required minimum distributions will ever force a taxable withdrawal. Most people who have accumulated retirement savings across multiple account types, a 401k, a Roth IRA, and a taxable brokerage account, have never deliberately thought about which investments belong in which account. They have the same broad market index fund in all three accounts because that is what was convenient or what their robo-advisor allocated automatically. By intentionally repositioning the portfolio so that bonds and REITs are inside the traditional IRA, index funds are in the taxable brokerage, and the highest expected return equity holdings are in the Roth, the same investment portfolio generates meaningfully better after-tax returns over a 20-year retirement without any change in the overall asset allocation or risk level. The Garcias did this review in the 2 years before retirement with their financial advisor. The Hendersons never thought about it because nobody brought it up. I want to bring the Henderson and Garcia comparison to a close because I want to make sure the point lands with the weight it deserves. Both couples started at 62 with identical financial positions. Same account balances, same Social Security expectations, same home values, same everything. The Garcias made 5 specific moves in the 5-year window before retirement. They ran the Roth conversion sprint to reduce their traditional account balance and future RMD exposure. They delayed Social Security to 70 using the IRA bridge strategy to capture the permanent 8% annual delay credit. They managed their income carefully in the 2 years before Medicare enrollment to avoid IRMAA surcharges. They made a thoughtful, modeled pension election decision that protected the surviving spouse's income. And they optimized asset location across their 3 account types to improve after-tax returns without changing their risk profile. The Hendersons did none of these things, not because they were careless or unintelligent, but because nobody laid these 5 moves out for them in plain language before the window closed. The difference in lifetime after-tax wealth between the 2 couples is not a small number. It is not the kind of difference you can look at and say, well, that is not worth worrying about. It is a difference between a retirement that feels genuinely comfortable and a retirement that requires constant monitoring of the balance, constant worry about whether the money will last, and constant regret about decisions that felt reasonable at the time, but that nobody explained the full consequences of. This is why Retire Right America exists. Not to give you vague inspirational advice about saving more and spending less, but to give you the specific, mechanically precise information about how the retirement income system actually works, what the tax consequences of each default decision actually are, and what the alternative moves look like in plain language that does not require a financial degree to understand. If you are within 5 years of retirement right now, I need you to do one thing before you close this video. Go to the comments section and tell me your age, how many years until you plan to retire, how much you currently have in a traditional 401k or IRA, and whether you have a pension. From that information, I can tell you in a reply which of these 5 moves is most urgent for your specific situation and what your single most important next step is. I read every comment on this channel. Drop your information and we work through it together. Like this video if the Henderson and Garcia comparison showed you something you had not seen clearly before. Subscribe to Retire Right America and hit the notification bell so every financial survival guide we produce lands in your feed before the relevant window closes. Share this with someone who is within 5 years of retirement and has not thought carefully about these 5 moves. Because the window is open right now, and the window does not stay open. This is Retire Right America. Stay informed, stay protected, and make the moves before retirement makes them irrelevant.